Guys, good to see you again. I'm really excited about recording this video because this is some common knowledge which everybody needs to know, all the retail trader needs to know, and I want this to reach to a lot of people. And I was having a casual chat with one of my trading friends about the trades that we took, and we happened to be in the same group, a common group, and I shared a few list of stocks to short for the last week, and it went well, and all those stocks had a small crash. So he was interested in knowing how much money did I make trading those stocks, and he was literally shocked when I told him I'm trading those with option spreads, and he was clueless, and he just asked me, why didn't you trade with futures? You would have made a lot more money. But I explained the logic behind me using option spreads, and how I can manage risk with this, and how futures is so dangerous trading swing, because in the name of capturing a small swing, and you open up yourself into unlimited risk by trading in futures, because there could be anything that can drive the price up or down, external factors, overnight gaps, and things like that, which are not under your control. And there are places where you cannot even place stop losses, like overnight gaps, or you literally get stuck in some positions and you're unable to exit, and things like that. They keep happening, and we've seen people doing that, and they're just hoping and praying and rolling over and taking losses because they got into a wrong position in futures. So when you trade in option spread, you literally have a stress-free trade. Once I see a setup, I just place the trade, and it's almost over for me. I just need to check after 3 or 4 days, literally, because the kind of risk that this offers is it'll be well within your risk appetite, and of course the risk is limited, and even the profit is limited. So mostly the risk reward is less, say around 1:1.1, 1:1, or 1.5, or maximum 1.2, 1:2. So this is how we should play with swing. And because I do not want that one super duper trade to define me as a trader, or that big trade should make me all the money for the month. No, I want to have these small trades, winning trades, keep happening over time, so that I grow in confidence. And that is how I've grown in confidence, by trading these setups, and these setups will never fail. I do not say that they'll never fail, but when I see a setup, I just put in a trade in option spread, and then most of the time I win. And there is no need for you to hold till the expiry, and as soon as you see some 7 or 8% of your margin returning back to you in the form of options, then you can just very well close the options. It happens in 3 or 4 days, or 5 days, or 6 days, whatever is the time, and you can just close it. And the market gives you so much of opportunities. These opportunities, like every week you can get 3 or 4 trades, so that is good enough. Even if you have even if you keep track of of say around 30 or 40 stocks, you'll still get trades in them. And this is stress free. That is the highlight of this. I'll just explain how this option works. We all know what swing trading is, and swing trading basically means that we have to see the trend, the overall trend of the stock. The higher time frame trend is up, so the stock goes up and makes a dip and goes up again, making higher highs and higher lows, and it keeps going up. So when we know that stock is in uptrend, by using any of any technical analysis, or by moving averages. So when the stock goes up and it takes a dip, we buy the dip. That is called buying the dips, and selling the rallies. Selling the rallies is exactly the opposite. When the stock is going downtrend and there is a rise in the stock, say something like this, we know that there is a downtrend. We identify the trends using the higher time frame. Higher time frame in this case is the weekly, and we see this. There's a downtrend going in the weekly chart, and anywhere in the middle here you will see some kind of a small rally. Something like this, which can be shorted. So that is how we catch a swing, by shorting the rally and buying the dips. So when this occurs, or where using any other, using any of the technical tools or the setups that you use, it might be a EMA support or Fibonacci support or trend line support, or whatever the tool that you use, you identify that there is some kind of support here and stock is going to go up. So instead of trading that in the future, in which case, as we discussed, you're opening up yourself to unlimited risk. What we do is, say, let me just give you an actual example of, say, somewhere here, you identify this downtrend, and you know that it is going up, and there is some potential for this to go down, and say maybe it is taking a resistance here at this zone, and you want to short this. So we are not exactly discussing the setup here. Setup can be anything. I'm just discussing the execution strategy. So here you see this big engulfing candle, and you think that it is going to go down, but you do not want to take such a huge risk in futures because the stop loss is huge, and then you basically don't want to take such a huge risk in this trade. So you just know that it is just going to go down because it might act as a huge resistance. It just going to go down. So what you need to do is, you need to make a option spread. What this means is that you're going to enter into two transactions. You're going to enter two transactions. So let's see, the stock is at 185. So this has to go down. You assume that it is going to go below 180. So you buy a 180 put, that is the next strike price put, and then you sell another out of the money put of, say, 175. So this is the current price, and you buy this put and sell this put. So what happens is that you basically limit your loss. Even if it goes up 10%, 20%, or even 100%, you're not going to lose anything more than that ceiling, which is the difference between this and this premium. So that is the maximum loss that you can have, and the maximum gain that you can have is the difference. These both should ideally expire worthless. Price is somewhere here or here. You'll make the maximum money, which will be so we'll just calculate how much of money you can make. Say we'll just see a current chart. Okay, say this is Vedanta's current chart. So I see some bullish move here. Ideally, this is not a trade that we are taking. We're just taking it for example. So say it is at 177. So I'm thinking that this stock is going to go up in the next few weeks, or in a week, or less than that, 1 or 2 weeks, maybe less than 2 weeks. Okay. So what I'm going to do is I'm going to buy the next strike put, 180 put, and I'm going to sell 185 put. So let me just pull this up. So it's crude oil inventory time. So this is option strategy builder tool from Upstocks, where you can I'll just show you how to use this tool. And the stock was Vedanta. Since it is almost the end of expiry, I'm going to use the next month expiry, and 180 call. Sorry, yeah, 180 call I'm going to buy. So which is 3.8, and 185 call I'm going to sell. Okay, so this is how it looks. And this is July expiry. Yes, July expiry. So this is the maximum loss that you will get even if the stock goes to 170, 150 or even 120. Let me just check the price again. Yeah, so even if it goes to 100 or 50 rupees, just like how Reliance Infra did from 130 to 60 rupees, so even that happens, your maximum loss is 2600, 2750, and the maximum gain happens when the stock at July it should be more than 180 or 85, and the maximum gain is 8700. So usually what we do is we say your margin requirement is around 60,000 for this trade, and when you see some 5,000 or 4,000, you can just exit the trade even if it happens in the next couple of days or 4 days or 5 days. So if you calculate the return on investment, it is huge. You don't need to wait till the expiry, which is next month, which is not, does not even make sense. So that is how this basically works. And if I had to show you some of the examples, the real example of a trade which I took, which is in Infratel. Yeah, this was the trade which I took this month, and this was, as you can see, this called a tweezer top. Exact high was both the days it had an exact high 288.5 and 288.5, and at the close of this day, just before the close, I made a trade. So when this happened, and I had another setup as well, which I'll explain that as well. So this here, I bought this put of 180 and then sold sorry, it's 280 put and sold 275. So what happened was, when the stock was here or somewhere here in the middle, I exited. I exited for some profit, and that is how it is. Like I just exit quickly, because it was almost like around 7 or 8% return in 2 days. So I just quit the trade. I just didn't want to hold it, because I could just use that margin to put in some other new trades, because this keeps happening, and you keep getting trades like this. And since it is your risk is very limited, you do not have any fear in entering these trades, and you pull the trigger really fast. And I really have just overcome the fear thing in the market. So I do not really, once the setup is formed, and once it is my kind of setup, I do not trade outside my setup. So if it is my setup, I do not fear to pull the trigger, and I just go with the flow. And actually, this exact trade at the maximum risk was around 2,400 rupees. So that was a no-brainer to enter this trade, and it didn't fail me. This trade didn't fail me, and the same with Tata Power, around the same week, which I took. From here till here, and then Idea is Dish TV last week. From this movie captured, and then there was some more. Godrej CP. From here. So this, so you can use any support or resistance, any support or resistance or supplier demands on whichever method which you are using. But I'll just explain one working method which do work. That is, this is the old traditional method of just plot the moving average. 50 is a very traditional moving average which many use. Make it orange. Okay. So 50 moving average, if you see, always almost acts like a support and resistance. And one more moving average that I use is the 169 moving average. This almost is like a magical moving average, which if you see this trade, this Godrej trade was actually taken for this. It was near the 169 moving average and had a bearish closing. And if you see my other trades of Infratel, this was a double resistance of even the 169 and this, and then even the weekly had some kind of resistance. Just taking time to load up. I think I just lost my internet. So that is how it is that EMA 50 and EMA 69 is a very good combination, which you can just go ahead and play around with and see on the daily chart and weekly chart. And then you'll see a lot of potential trades in them, and keep checking every day, end of the day. Say if you have a list of 50 or 60 stocks, or even less will do, like 20 to 25 stocks is fine. You can just keep checking them every day for such setups, and just try to combine them with any candle bearish or bullish candle formations, and then you can just do a paper trade on this for at least 21 days, 21, 28 days, 30 days, or however you're comfortable with. But you just do it, write it down, the option strike prices, and you can just you'll know the power of this, and you can, when you actually trade this, it will be really stress free,